Good morning, everyone. Did anybody see Flat Roof Freddy
On Twitter?
on Twitter?
X?
No, I saw him
No,
this
no, I
morning.
thought Flat Roof Freddy was here this morning.
No. I guess we can just get started. He posted a tweet last night. Maybe do it.
There it is.
There you go. Flat Roof Freddy. We have another roofing guy. Went viral last night. Since he's not here, I guess I'll tell a story. So, Flat Roof Freddy. He was a self-funded searcher. It's a true story from February 2023, and he's looking to acquire a business in Florida, a roofing business. The company was doing $10 million in sales. 7 million of that was commercial flat roof, and then 3 million was new construction. Now, what's important here with the new construction is that the new construction work, Flat Roof Freddy's company was working as a subcontractor under a general contractor. And the general contractor had a special insurance program known as a wrap-up. The wrap-up insurance program effectively just wraps around all other individual subcontractors. So whether that's the painter, whether that's HVAC, plumbing, and there's a number of reasons for it, but it's so that really cost control and making sure the general contractor, all the subcontractors are properly insured. Well, because of that, because the general contractor was buying the insurance, the Flat Roof Freddy's company didn't need to spend, for the $3 million of revenue, didn't need that insurance. So their insurance premium was going up, 40%. And the reason that it's 40 is that new construction has a higher rate than, repair work. It's extremely high risk. Additionally, this company in Florida, all the employees were transitioned from W-2 employees to 1099, subcontractors. And however, there was no process in place to ensure that the 1099 contractors had their own insurance. There were no subcontractors in place. They weren't collecting certificates of insurance. So, from an insurance standpoint, insurance company, they were really affected. The insurance company was looking at it as like, well, those are your employees. And when we were looking at the loss runs, there were claims that were occurring on the workers' comp side, and from 1099 contractors because they didn't have their own insurance. And here's actual kind of loss run report from, just one of the years. You have a $40,000 claim from a 1099 subcontractor. The point of this story is a couple things. One is, insurance is complex. It's probably likely outside of your, operating wheelhouse. Maybe you've procured insurance through, your personal, but this is completely different world. And also, if you can improve the risk profile, you can increase enterprise value, and you can kind of expand the business. So,
Who we are. Yeah. Thank you. Flat Roof Freddy story, everybody.
Follow Flat Roof Freddy.
Indeed. So why do we do insurance diligence? That's the point. This is important to just say the obvious thing. It's to make sure that if you buy a business, number one, you don't overpay for things like an insurance. In Flat Roof Freddy's example, we found that the company was overpaying and we're able to immediately create value by lowering their insurance costs. And then the other thing is to make sure you're not buying a business that has all kinds of issues with it, where you find out you're fundamentally uninsured for things you thought you were. So who we are. Andy Harbut. I've done insurance due diligence for M&A deals for almost 20 years. I started at a broker called Aon, which is one of the two biggest brokers in the world, doing deals for private equity firms. All kinds of big stuff for Apollo and Cerberus and Carlisle. My claim to fame is that I insured Twinkies. I have all kinds of stories about that. They don't last, they won't survive the nuclear blast, but they will last a couple of months in your shelf. Met Josh I don't know, 3 years ago, and have been focused on SMB ETA ever since.
Yeah, so we were friendly competitors. I've been doing, kind of fell into it by accident, was doing more middle market stuff. 13, 14 years ago, search funds was actually called pledge funds. And some of those earlier deals I worked on were very successful, would get sold to middle market clients. Those searchers went out, started funds, and kind of saw the whole birth of, search fund, ETA, and this whole movement. I think, we were joking about this last night. I think I have more deals, but your transaction value is way
My
higher.
enterprise value is higher. His deal
Yeah.
count is higher.
Um, so if there's anything I really want to get out of this presentation for you guys, it's this slide. It's low risk business and the high risk business. Low risk businesses. What is that? Let's just say kind of bookkeeping, accounting, a lot of SaaS businesses. Those businesses, is going to be easy to procure insurance for the most part. There's going to be a lot of insurance companies and markets that are interested, that want to write your business. You're going to get really good terms, and because of that, you're also going to have you're going to get a lot more coverage at a lower premium. Honestly, um, compared to your high risk business like Flat Roof Freddy, the market is really skinny for roofers that do new construction. In Florida, you're going to be paying a lot of premium for it. You better get it right. Insurance is going to be your second or third highest cost, outside of payroll. And because of this higher premium, you're getting less coverage. So you really got to understand, insurance. Just because you're buying a $3 million, business, if it's HVAC, if it's roofing, if it's parts of healthcare, insurance will be your second or third largest, kind of cost. And there's ways to kind of, as we spoke about, whether that's transferring the risk, avoiding the risk, mitigating the risk, and kind of using different risk controls, to enhance your overall risk profile.
5 commercial coverages everybody needs. So we we don't want to get too far in the weeds, but we want to put some guardrails up. Really, what are we talking about when we talk about business insurance? And the basics of it is that there are really only 5 different types of policies that just about every business needs, and there'll be some specialty coverages, and we'll talk about that as well. But so that everybody knows what we're talking about, we're going to talk about these 5 commercial types of insurance. Some of the names are similar to what you might see in your personal insurance, but the policies differ considerably. So I almost want to say whatever you think you know about insurance from buying insurance for yourself personally, throw it out the window. This stuff's all a little bit different.
Yeah, and these are just to kind of set the guardrails, so give you a better understanding for
And,
some of this stuff later to come.
and I think the insurance industry in general loves to make it seem more complicated than it is and use terminology like this is a bespoke, specialized insurance policy that's unique and custom for your business. The first example here, I think, is proves that that's not true. So, general liability insurance, just about everybody needs. I think it's funny. It's called general liability insurance because it generally applies to any business, and the policies are almost all exactly the same. They have 4 primary coverage parts. The first is premises liability. So if you have a retail operation or a hotel or event center, any place where you might have the general public onto your premises, slip and falls, you have a duty to provide a safe place for people. That's premises liability. Second part, products liability. Um, any business that sells a product, whether it's a widget or a Twinkie, whether it's something you eat or something you play sports with, it's all products liability. And again, there's a duty to have a safe product in the stream of commerce, and that's the coverage for that. Completed operations, super important if you're looking at servicing businesses like plumbing businesses or HVAC. This is actually not a particularly well understood part for roofers is a great example. Because people think, oh gosh, I've got general liability insurance. If I have a warranty claim 3 years down the road, am I covered because I had general liability insurance? And it doesn't quite work that way. But think about it for liability arising for the work you do for other people. So if you're a plumber and you install a washing machine, but didn't quite tighten the hose right and you flood somebody's house, completed operations coverage. And finally, the other big part is personal and advertising injury, and that's things like libel and slander. Um, There's some blend depending on the type of business. If it's a media business, this coverage is less important. But for the typical SMB that maybe runs an advertisement, once in a while on Facebook, it's probably okay.
And this will be any lender is going to require this coverage to be in place. Next is commercial property. Commercial property is broken down into three different parts. The first is the building. It's really common in uh, SMB transactions that the seller owns the building, and the lease agreement and who's responsible for building coverage is really important, especially in Florida and California, parts of Texas, and you need to kind of have that clarified. Next is everything inside the building, whether that's inventory, desks, chairs, product. That's the contents or the business personal property. And then you have what's called business income or business interruption. If there was a fire to the building, the business income would pay the net income you would have earned during the period of restoration. So that's payroll, that's debt service. Getting that number right is critically important. Maybe not so much flat roof ready because the operations are off premises, but if your operations are on premises, um, critically important to get that right. Again, lender will require that coverage to be in place.
Workers' compensation is required in all 50 states. If an employee is injured in the course of their employment, it's a statutory coverage that covers their medical bills and lost wages while they're recovering. There's also a component of the coverage called employer's liability, so that if a tort lawsuit happens because of an employee injury, the policy covers the employer's liability for that as well. And that can happen when things like the classic example is, so you have a manufacturing facility and you take the guards off of the table saws, or you take guardrails off of an assembly line and somebody loses a hand. That's obviously a pretty egregious thing, and you can get sued for that. Go figure.
Other thing to note on workers' comp, a lot of times, you want to get into a PEO. Workers' comp is extremely profitable line of coverage for the insurance companies. That's why the payroll provider or the PEO really wants it. And they try to use tricks when they're trying to rate it in terms of what the actual rate for workers' comp, is. Business auto, um, if you have a fleet of vehicles, third party liability. If you were to get into an accident, you also have damage comprehensive to your vehicle. What's important to note here, you also have a coverage called a hired and non-owned auto. That is essentially if an employee is using their personal vehicle for business purposes, or if they rent a vehicle, there's liability coverage in place. What's important here is that coverage is excess any personal coverage they have. So if an employee only has a statutory minimum of 30,000, then the business auto coverage, comes into play. The hired and non-owned.
Yeah.
Umbrella. This gets a really bad name. Umbrella only sits over business auto, your general liability, and really the employer's liability of workers' comp. A lot of people come to me and they're like, "Hey, I have an umbrella policy. It's going to cover cyber. Oh, it's going to cover damage to the building."
So
it doesn't, right?
This is the fun call and response part, and feel free to shout out if you got any questions about umbrella. Does it cover sexual harassment claims?
No.
Would it cover a hacker that
Nope.
takes down the system? What other crazy things can people think of? Earthquake. People have asked me, does it cover earthquake? No. It's really, when you think about umbrella insurance, and this is hugely important.
P. Diddy's.
Oh, P. Diddy, right? Yeah, P. Diddy's off. Yeah, I forget about that one. None of that's covered. Right. It's really cars, people working, premise, general liability, and if you're lucky if it covers anything else. I don't know that I've ever seen it in 23 years. So
yeah, just important. It really only covers what's scheduled, and that's it. I get the question with probably 50% of deals that I work on.
And the policies they should consider. So 5 types, everybody should have some type of. There's really 3 other types of insurance that when we engage with searchers, we talk about, gosh, if you should really think about these. First is management liability. That's a term that refers to 4 types of coverage. They're typically on the same insurance policy. It includes directors and officers liability. So if you have a board of directors, if you get someone to serve on your board, there's a good possibility they'll say, hey, we want D&O insurance in case we're sued for our fiduciary liability by being on your board. If we give you bad advice and an investor says the board made a mistake, that's D&O insurance. Employment practices liability. We mentioned the sexual harassment example. General liability insurance that you'd buy for the business typically does not cover employment practices liability. And so the things you think about for sexual harassment, wrongful termination, discrimination, failure to promote, that sort of bucket of risk falls into employment practices liability. Fiduciary liability typically is narrowly defined. That's another kind of funny term. You think fiduciary liability, okay, what could that mean? It's really tailored coverage for 401k plans and other employee benefit plans as defined by the ERISA Act. So if you offer a 401k for your employees, but the options are terrible and everybody loses all of their money, fiduciary liability.
Yeah.
And then finally, crime insurance. And so crime insurance it's coverage for theft of money or securities. So a property insurance policy will cover theft of the business's tangible assets. But if you've got the classic example is like, Steve in accounting creates a fake vendor, sends out $2,500 a month to a vendor that you've never heard of, and it turns out that vendor is actually Steve's cousin. So white collar crime and embezzlement, that falls under crime insurance.
Yeah. And if you don't want to buy any of these, be really mindful, as a new CEO, and if you were to terminate employees, consult an attorney, make sure that's done right. We see a lot of that when there's a new CEO comes in. 6 months later, they start to, who's working, who's not, and then the employee files a claim. Cyber, I think honestly everybody should have a cyber policy. Invoice manipulation, social engineering, funds transfer fraud. I see this a lot, and it's fairly inexpensive for how broad of coverage it has. Just a couple weeks ago, there was a client, they got a fraudulent invoice for $144,000. Accountant paid it. They didn't realize it, until afterwards. It hit the cyber policy, and the cyber insurer just paid, actually.
Yeah. What you want to avoid
and that policy costs $2,500. So
right. Super cheap, cheap for now.
Yeah.
I think a lot of the stuff is you want to avoid this scenario, and I feel like I hear this all the time of, we had this thing happen, don't we have coverage for that? We don't have coverage. And so what we say are these recommended coverages cover 95% of the things the business could run into. Bucket number 3 here, other. Anybody who's run a business or bought insurance almost always has some story of, well, what about E&O? What about marine cargo insurance? Well, I've got these guys on a dock in Jacksonville. We'd have to have Jones Act coverage. So there's a bunch of different specialty insurance products that exist for these sort of unique exposures. But the reason we say other is we can't say that universally they're going to apply on your deal, but they definitely come up. So, okay, this is the most important slide in the whole deck. It's my favorite. He lets me run with it. All right, everybody, get excited. So here's my jam. People say, okay, you do insurance diligence. Here's a stack of insurance policies. Are we good? And my answer to that is, I'll tell you as much as I possibly can from these policies. I can tell you what the policies cover. But am I really doing diligence? And my answer is, not really. And the reason for that is, the way I look at insurance diligence is it's as close to doing total business diligence as any of the diligence disciplines out there, right? It's Gestalt. We've got to look at everything. And when I say we have to look at everything, we have to understand the business. So, for example, property insurance. I can tell you what the property policy covers, but do I know if the limits are adequate, right? So say you're buying a bunch of inventory. Well, I'm going to look at the balance sheet and figure out what the inventory levels look like year over year and month over month, try to figure out if there's seasonality there, try to figure out the inventory values in the balance sheet match what's on the insurance policy. If you're buying a business and you need to have a third-party valuation of the real estate, for example, we'll look at that third-party valuation to understand what's the replacement cost of that property. Is it a unique property? If it's an industrial facility or something like that, are you going to have a harder time with business income interruption losses because you wouldn't be able to easily move your operations to a different facility? And don't even get me started on deferred capex. That's a whole other session. Legal diligence. This is huge. One of the biggest things we see is that SMB operators enter into contracts without reading what are the insurance requirements of those contracts. And so we can look at a stack of insurance policies and tell you, here are the liability limits. But if your business has, certain contractual requirements with key customers, if we don't look at those contracts, we can't tell you if the liability limits are sufficient for everything the business might need to have.
Yeah, and that's especially important. I mean, when you're coming in, a lot of these deals are asset purchases. You're going to have a new entity that's set up. You're going to be required to then submit certificates of insurance endorsements to that customer and or client. You don't want to find out, day five that hey, the contract required 10 million of umbrella and you
We,
only had three, and so forth. That's stuff that you can bring out, talk about with the seller, in advance.
I'm dealing with that right now with a client, and I think this is the craziest thing. They give us a schedule of insurance. They give us all the policies. I get anal retentive about this stuff. I want to see the seller disclosure schedule. So ultimately, the purchase agreement is going to reflect what policies they buy. And we found the client had a contract with UPS that required crime insurance that was not disclosed anywhere in the disclosures and the policies during the diligence process. And the only way I found it was on the list of vendors and top 25 vendors payable that I found this crime insurance policy that they were buying that we had no idea. And then literally that policy expired. And now our client, the S&B operator, I had to go back to, well, they got this. They said, hey, can you give us a new certificate of insurance for UPS? And I said, sure, but did you know about this crime policy you have to buy? No. So happens all the time. Q of E, huge part of what we do. The Q of E guys, typically they'll look at, gosh, let's figure out what normalized cash flows look like and try to make sure that, you're making adjustments to seller discretionary earnings that make EBITDA make sense, right? Insurance policy premiums aren't static. So when you buy an insurance policy for general liability insurance and workers' compensation insurance specifically, those policy premiums are adjustable after the policy period based on the actual revenues or payrolls of the business during that policy period. Hopefully this is tracking. We'll get into it a little bit later too. But what it creates is this Q of E issue where you can look at the trailing 12 months insurance expense, and it basically it can be misstated by too much or too little because the policies have this audit function. And so typically Q of E providers don't look at that audit function to figure out, okay, is the insurance expense actually accurate or is it going to change? And we help kind of align those numbers so that you have a normalized run rate for insurance expense.
Yeah, extremely important for blue collar when you're kind of bidding on jobs. The seller, lowers, low balls, the initial, revenue they think they're going to do, and then later on they do triple that. Insurance will reflect that. We'll
Totally.
get into that a little
It's like pre-premium financing. Environmental issues, really big. All the insurance we talked about earlier almost universally does not cover environmental liability with a handful of exceptions. So if you're buying real estate or you're buying a business that has environmental liability risks like clean up pollutants, dispose of pollutants, things like that, the hydrovac trucks are getting super popular for some reason. Environmental regulation and insurance is a whole separate bucket of risk. And then finally, transactional risk. And so part of what we do during the diligence process is to understand what are the assets and liabilities assumed in the purchase agreement. Where do you have seller indemnification for uninsured risks? And how do we recommend sort of boxing that in to protect your interest going forward so that you're not assuming uninsured risks and stuff you didn't know about going forward?
Yeah, so what we typically do is provide an acquisition insurance report. And really, our work basis begins with understanding the transaction structure and really what the intent of the purchase agreement is. Whether it's an ass, a stock, F reorg, depending on the transaction structure, is the policy is going to be able to transfer over to NewCo. And additionally, we're going to go look at the coverage gaps, any impacts it's going to have on EBITDA, and ultimately valuation, do a deep dive into, kind of claims analysis. And this is also, I think I have a redacted report towards the end, an opportunity for you guys. You're in a transaction role right now if you're a searcher. Once you find, identify, and move into the role of CEO, insurance is going to be in your hands. It's not like these are middle market firms that have a whole risk control team. It's going to fall on you. So it's also just an opportunity for you guys to really understand, the insurance program of the business. Oh,
Coverage gaps.
that
But
did not transfer over. That's
I feel
weird.
like we're missing a
Right.
visual, right?
Yeah.
So missing policies is literally missing.
What? What? Okay. And there's be a handout toward the end, but we'll get there. Yeah, it's weird. Yeah. All right.
I got this one.
Yeah,
I'll
go
get
for it.
this one. All right.
It's
Missing policies. It's remarkable. We talked about the 5 coverages that every business needs. Well, if you're buying a business from an entrepreneur or a founder that never took out bank debt and never had anyone looking over their shoulder, those are typically risk takers, and those are people who have been focused on marketing and sales and building their business there, and not necessarily, hey, do I have all the right insurance policies? Maybe they've had a good run of it and they've never been sued for anything, and so the stuff we've talked about, like, do they have auto coverage? Well, silly as it is, a lot of businesses say, geez, we don't own any autos. Why do we buy auto liability insurance?
yeah.
Well, it's that hired and non-owned auto that Josh talked about.
Yeah, I mean, this one was actually a picture of a trailer, and it was actually a deal that was done last year. The insured was buying a trailer manufacturer, and there was just no general liability policy whatsoever in place. Obviously, a major issue going forward, but then also, I mean, there's whole successor liability issues. This other one, we're doing a deal of a fire suppression company um, in Colorado, and 5% of the work was actually done at aircraft hangars. Looking at the policy, there's an aircraft hangar and marine exclusion on the policy. What's going to happen if there's a claim that occurred at that job site? I mean, there's no coverage in place, and these are serious contracts. I mean, the insured had, I think it was a $10 million umbrella policy, for their work. And they were able to kind of negotiate with the seller because this is hugely important.
Okay, premium rating basis. This kind of gets to the Q of E issue. Um, there's really 2 components to it. There's the basis of the rating basis itself, and then the classification. And so the rating basis is, if you think about, let's talk about general liability because it's pretty easy to understand. Typically, general liability will be rated on sales. So you buy to go to buy a general liability policy, you tell your broker, hey, I think I'm going to do $10 million in sales next year. And that's what the insurance company uses to determine the premium for the policy at inception. What happens is when the policy expires, you get a letter from the insurance company that says, send us your books and records for the actual revenue you had during that policy period. And then what they will do is adjust the premium, and they'll send you a bill. Typically it's a bill because hopefully you've exceeded your revenue estimate. Technically they can also return premium, but if they return premium, it's kind of like a tax refund. It means you paid too much to begin with. So generally the advice is, hey, aim a little bit lower. But if we look at an insurance policy and we say, gosh, the seller reported sales of $3 million, but you're looking at a sim that says the business is going to do 5, then we say, okay, gosh, you got to make an adjustment here because you're thinking that this business is going to do $5 million in trailing revenue and the insurance cost is going to be 100 grand. Well, the reality is it's going to be 140 when they get the bill after the policy expires.
Yeah, and a couple quick things there. One is, if it's a stock purchase and you're assuming the policy, I mean, that's going to be your liability. Even if it's an asset purchase, and it will remain with the seller, that liability, if it's audited, you need to know what the go forward insurance
And
expense, is.
and working capital too, because it factors into the prepaid. So you're going to have prepaid insurance as the current asset, right? And if that number is too low because they lowballed their expected revenue, you're going to want to know about that beforehand.
Yeah.
And
And rating classification. So, for instance, for here was a picture of a plumber, but in a lot of states, there's a difference between a plumber that's making, I think it's above like $40 an hour, versus a low wage plumber that's making less than $40 an hour. And the reason for that is that, a high wage plumber, more experience, it's been proven they have less likely to have claims. Well, if you're buying an HVAC business, plumbing business, how are they classified? Are they all the entire workforce lumped into that, higher class code? It can make a material, difference. And it goes on. I mean, it could be, um, eh, if they're on the machine shop floor, but they're not actually, part of the, a technician or machine shop, they could still be classified. I've been part of, especially within middle market firms where investors are unsure of the rating classification, have us get letters from NCCI to kind of verify it. I mean, for certain businesses, it's hugely important.
The gist of it is you can't assume that the insurance premiums are guaranteed. There can that's I think this is an overarching thing I want people to get. It's that there's risk in insurance. Please. Yeah, absolutely, I would say, but there's also economies of scale, and there's also minimum premiums, and there's a whole bunch of factors. But generally, I think that's one of our major takeaways is like, don't just go, well, I got to shop my insurance. I need to get my insurance costs down. The best practice as an operator is to be thinking about risk controls and MVR drivers.
Yeah,
This is
and to
huge.
implement in telematics, that could be a 5, to 10% discount at sometimes. Having drivers do, defensive driving, absolutely. With subcontractor agreements, making sure that your subcontractors are properly insured. Within the policy in the previous slide, there could be a line where it says uninsured subs, and the rate they're going to charge you is probably 3 to 4 times higher because they're expecting you to kind of take that risk control away. Eh, so it's kind of a combination. I mean, as you kind of scale, you need to have almost these in place because then you're going to attract more markets that are going to be interested in your business.
So in the acquisition insurance report, current cost analysis, pretty straightforward. We look at, hey, here's a stack of insurance policies. Here's what they're paying, and if they were doing everything that they're supposed to be doing, what would it actually cost? What they're supposed to be doing is things like, is there a contract the company is not complying with and they have to add a policy, right? Or the audit adjustment that we just talked about. If the policies say 3 million in revenue, but your model's based on TTM 5 million in revenue, we'll tell you what the insurance should actually cost based on those factors.
Yeah. A lot of times also it doesn't always get picked up, but the seller has his personal vehicle,
Totally.
his spouse's personal vehicle, his kids' vehicles, and you can actually kind of see sometimes business auto go down because of that.
Yeah,
And it really gets kind of picked up within the any advex.
Yep. And the
Investments.
property too, right? We talked about that a little bit. We're sellers on real estate, and if the real estate's coming off of the deal going forward, is that something you have to cover, or is that something the seller's going to continue to insure? Projected. So
What? Revenue range. I mean, this was
$100,000. I'm going to say this was probably a $4 million company. So I think about insurance costs as a percentage of revenue in general. And when we were talking about low risk businesses, insurance costs might be 25 basis points of total revenue. Higher risk businesses like roofers, 4, 5, 6%, sometimes 10%.
It also location matters.
Huge.
I mean, if you have a roofer in California, you do not get workers' comp right, you will be out of business.
Yeah.
So location matters.
So besides like the actual type of work the business is doing, the other big drivers of insurance costs are location, for 2 reasons. Coastal locations, anywhere it's called catastrophic or cat exposure for earthquake or windstorm, that makes property insurance more expensive. And then the other driver is legal liability, and that tends to be driven on the state level. So certain states have more favorable, they're more favorable to plaintiffs than businesses, right? So Florida and New Jersey, for auto insurance and employment practices liability. California, everybody talks about employment practices liability in California because
Yeah, I mean,
It's
retentions will start at deductibles will start at 100,000.
yeah.
So,
So
anything you want to touch here?
and then the projected cost analysis. This part of the acquisition insurance report is, hey, we've already talked about these pro forma adjustments, assuming the seller buys adequate levels of insurance for the business so that you can continue operating it as is. And that's more about Q of E. Projected cost analysis is okay, maybe you're going to have a board and you're going to want to add D&O insurance, or your sleep at night comfort is above and beyond minimum requirements to operate the business. So it's things like, do we add the cyber insurance? Do we increase the umbrella liability insurance? And so when I think about projected cost analysis, I think this is more about what best practices, recommended insurance versus sort of Q of E adjustment. We found something, a negotiate your purchase price moment. This is more about, hey, if you're reasonable and prudent, this is what you'd spend on insurance.
None of the pictures are coming, but here's a couple things. We always ask for we're gonna ask for loss runs. You're gonna come back to me and say, the seller's stressed out. I can't ask them any more requests. Loss runs are incredibly important, and the reason they're incredibly important is that current year's premium is not current year's claims are not factored into current year's premium. So if they've had a poor year, that hasn't been completely reflected, into the current year's premium. I mean, we're doing a utilities contractor right now.
That's where I was going.
Is it $4 million workers' comp claim?
It's terrible. Guy lost 2 arms. Yeah. And it was the timing of it was that it wasn't reflected. So the way the claim happened, it was in November of 21, just coincidentally. And we were looking at the business in November of 22. I'm 1 year behind. It happened in November 22. We looked at it in November 23. The workers' comp policy renewed in January of 24. And so our client had done his Q of E, he'd done his legal diligence, he was planning to close on the business in January. And we looked at the loss runs and we said, hey, there's this $4 million workers' comp claim that hasn't hit the experience rating yet, and it hasn't hit the premium. And so literally it blew up his deal. And the reason for that was the way and in fact, I want you to explain this because you do it better than I do. The X mod.
And the reason it's important, you have something for workers' comp called the experience modification factor, or X mod. Everybody I say is one is your C student, just average. If you have poor claims, you'll go to 1.10, 1.5, 2.0. That means you're 10, 50%, 200% worse than your industry peers. Now your industry peers are the same workers, so utility contractor, let's just say in the state of Texas. If you're below 1, 0.9, 0.8, you're 10, 20% better than your peers. And you're getting a 20% discount on your workers' comp premium. It's and for you guys, for a searcher that's going to be the CEO of the company, that gives you great insight into the company. Are they legit claims? Is there maybe a frequency issue, a risk control issue? How do the employees feel about the company? Maybe it's even a reflection of that they don't have strong health care, or if any, and they're using the workers' comp because of that. So it's really good insight into the business. The other thing why it's really important, especially in some of the trades, is that when you're bidding on contracts, you'll reach out and say, hey, can you have your insurance broker sign a piece of paper, sign a letter saying, hey, the X mod is 0.9. They may not want to work with you if your X mod is above a 1.3. And it makes sense. Why do they want to, between 2 contractors, why do they want to potentially hire one that's prone to claims? And could, even though you have your own insurance, hopefully, they could still be brought into a claim, into the work site. And really important.
And so what happened for our client was this $4 million workers' comp claim hadn't hit the X mod of the business he was buying. And we modeled it and said, when this gets adjusted next month, it's going to take the X mod from 0.7 to 1.3. And there's software out there we can use if we need to model an X mod to tell you what it's going to be in the future. We do that. And the long and short of it was, for this business, our buyer, our client, knew that if that X mod went to 1.3 within that industry, he wasn't going to be able to grow the business because there's a hard and fast rule with utility companies that we won't hire subcontractors with X mods over 1.0. And so it literally is shelved the deal. So really, really important. So you got to ask for the loss runs. Nobody wants them, but yeah, please. So it's the X mod's calculated every year, and it is a function of 3 of the last 4 policy periods, excluding the most recent. And so it's a kind of, I don't want to say it's a black box, but the algorithm is not widely known. And so it takes typically 4 years for a claim to fall off. But there's like limiting factors and stuff. So the bigger issue is usually frequency over severity. So it's not like $4 million claim, this business is totally uninsurable, run for the hills. But hey, that's a big deal. Let's keep an eye on this. What happened? And the other rule of thumb is frequency leads to severity. So
Yeah.
Well, it's like, so building off like what you just said with that utility company and kind of what he was saying too, how could that company get their number down where, like what you're saying, the state basically wouldn't allow them to operate because their X mod was too high. So, I mean, that just the previous owner just had to close their doors because they can't work anymore. Like,
So they're able to stay on the current contracts, but it was a question of bidding for new jobs.
okay.
But this gets into the SMB shenanigans, which we really need to slide for shenanigans. Some of the stuff we looked at is crazy, right? There's like guys who run $5 and $10 million businesses are wild. It's wild and woolly, and that's why I love doing this stuff. Do you want to talk about X-Mod washing and some of the things you've seen?
Probably not on camera, but
Not that you've done, just that you've seen. We don't do this stuff.
A question I get all the time. Okay, did an asset purchase. I'm setting up Nuco. That's the seller's responsibility. I should start at 1. I get that. It's a hard case, to be honest with you, to make to the insurer because on one side we're saying, hey, we have a new CEO coming, same business, same operations. We're going to make a case that hey, new owner's going to be a steward of risk management. He's going to implement all these things, but X1 is your X1. There's ways. I've seen ways that you can hide in PEOs, hide in payroll companies, but they've gotten a lot smarter about it and tracking it because it was a huge problem.
Yeah, I mean, I did diligence on a company years ago where the seller, during the diligence process, volunteered to me. Yeah, our X-Mod got a little hairy, got a little bad. So I bought this other company and I transferred all of my payroll to it because X-Mod typically follows the EIN and that's how it's tracked. But now the rating bureaus, the big one's called NCCI, and that's the organization that calculates X-Mods. They basically will track the EINs and the ownership of the individual LLCs and entities that blow up. So they try to track it by the contractor, the one dude. That's what they try to do.
And the flip side to this is, what happens if you're looking at a company and it's 0.6? What do you think that is? What do you think that means? Anybody?
It sounds
40% better than your peers?
Right. But
in my experience, anything that's really been below a 0.7 or so is that the seller has likely been paying, out of pocket for workers' comp, issues. Hasn't been reporting it to the state.
Yeah.
And it can blow up in your face pretty bad. I can tell you stories offline where I've seen, even searchers try to take that practice post-close and strongly advise, against it. So anywhere around 1, even at 1.1 is fine. I'd say anywhere between, 0.7 and 1.1 is fine.
Yeah.
Give or take.
And generally speaking, too, it's the distribution is left skewed. So if you see over 1.2, 1.3, 1.4, that's less common than to see 0.8, 0.9. It's bigger. It's a bigger red flag if you see a high number. So.
And the other thing on this note, especially holdcos here, if you're looking to buy and build, you have a great company, great risk control. You have a 0.9. All of a sudden, you're looking at this company. You want to acquire another company, and they have poor risk control. And they have an X-Mod of 1.5. We need to have a talk where, hey, do we want to merge the programs together? Do you want to spoil the water with this one? Maybe you have a separate entity for the workers' comp. You got to be mindful, mindful of it.
And the reason for this, just real quick, is the way it's supposed to work is that the experience rating is supposed to sit at the topmost entity. So if you're building a holdco, in theory, if the insurance company is really pushing on it, they're going to combine the experience of all the portfolio or all the subsidiary companies. Even if you go, well, my plumbing company has nothing to do with my HVAC company, it could still be a blended experience rating.
Yeah. Cool. So get the loss runs, the currently valued loss runs. Yes, another picture's transferred. Shame on me. Ways to improve risk. Look at MVRs.
Does everybody know what MVRs are? Anybody? No one knows.
Motor vehicle reports.
Is it basically a driving record?
I can't tell you how especially in HVAC, plumbing, towing, how hard it is to hire. For those workers, a lot of the time, their MVR is their resume. I can't tell you how many times searchers have come to me like, Josh, I need drivers, I need technicians. I'm like, dude, I don't know how you insure him. He's got a DUI, he's got a reckless driving. You want to, before you hire, look at those. Are they insurable? Use subcontractor agreements, use telematics. Cybersecurity, everybody should have this policy. And there's ways to do a penetration test. We can enter in a website and they'll come back to us pretty quickly with a report. And they'll let you know of any cyber vulnerabilities, leaked email addresses. And what's kind of going on right now in the insurtech world is they'll come back and say, hey, you guys, look great. Job is updated. We want to write your business and we're giving you a discount. They'll come back and say, hey, you got to clean this up, and then we'll write it. You guys are a mess. It's actually a free cost, part of the acquisition report, but it really, all companies, should have it, especially if you're transferring.
Next time we do this, we're going to move cyber over to the 6 policies that all companies should buy.
Yeah, agreed. And then, do you want to do this?
Sure.
Typically, there was like the Rolex or the Apple Watch.
All right.
Sell watch, I'll watch them separated.
I want to be my
Does cyber cover vendor breaches?
It can. It can cover, especially like business income, like offsite. If your vendor was down, you got to tailor. It depends on the company and if it's needed.
Okay, so transaction impacts stuff. I want to reiterate this because I don't know if we said it strong enough earlier. Probably 90% of the ETA deals we see are structured as asset purchases, usually for tax reasons and a bunch of other reasons. But insurance policies generally, you can't assume that they're going to survive a transaction. There are legal contracts between the old co and the new co, legal contract between the old co and the insurance company. And generally, insurance companies don't want to assign those contracts to a new co. So our starting point is typically, we need to understand the purchase and sale agreement, if it's an asset-only deal, if it's a stock deal. And then what follows from that is, are you taking the insurance policies or are you not taking the policies? And there's a lot of reasons not to take the policies, to leave those liabilities behind with the seller, and to bifurcate the insurance asset. So you've got clean insurance limits that are dedicated to your business on day one, because otherwise you're going to be sharing liability limits with the seller. That kind of flows into the our watch, their watch. If your purchase agreement structured where you've got seller indemnity for liability arising from pre-closed stuff, whatever that might be.
Because like sexual harassment, there's a sexual harassment claim that arised, that occurred before you acquired the company, then post-close there was a claim filed. Insurance will come in there and dictate, you can buy tail coverage or runoff coverage, for those cases.
Yep.
I think we kind of just jumped to a lot of.
What do we do besides diligence? I feel like that's a fair.
Yeah, really the execution. I think in our experience is that, PE firms are really good at doing deals. Got all the advisors, for you, you've got yourself, maybe an analyst or so. Really our job is that whole first kind of part was just really EBITDA protection, risk control, understanding. I always tell people in this space, work with people that know how to execute. There's a lot of moving parts. Your lender is going to be kind of pounding down the table for insurance requirement, certificates, endorsements. So just making it honestly, a smooth process for you guys. I don't know where to go. So we kind of hit on all these. I guess I'm gonna open it up. Any questions?
You were kind of alluding to this just a second ago, but so why do you need insurance diligence if you're going to be getting a new policy going forward anyways?
first thing is don't assume that the old policy cost is the right cost, right? So if part of what we do is just get you quotes for new coverage, frankly.
Yeah.
And the idea is, okay, you're buying this business and you're looking at your P&L and they spent $100,000 on insurance and your value is going to be pegged to what they've been spending on insurance. And what we're doing is we're coming and saying, hey, you need new policies, but this is the cost delta and here's why. And is
So,
that
if we had paid for like the Guardian due diligence or one of the other ones and had them do the due diligence and sent you the numbers to build the new plan, would that be adequate, or would you still obviously want to do the diligence to figure out like so you guys can get your eyes on what's actually going on?
Yeah, and also it's important to note we're cost neutral, just so you know. So it's not. I actually did this a similar presentation a little bit ago. Somebody comes up to me like, Josh, love the presentation. I give you a critique. I'm like, yeah, go for it. Got thick skin. It's like you should just open that saying that your work is complimentary. Your work is free. We actually don't charge for our work as well. You know,
we don't charge a fee.
Whether you just if you were to engage us to just place new policy, we're still going to do the diligence to kind of let you know what's in place.
Okay.
You know, our goal is hopefully we can improve upon it. You know, from a cost perspective, get a good process and smooth transfer for us. We get paid through the insurance companies.
Okay.
So.
And there's stuff, you know, you can hand us Elliot's report, and I can do a lot with the QB report. But it's, generally speaking, the more we know, the more comfortable we can get with the business to get our arms around it, the less likely it is we're going to miss something. And so my preference is if it's a proprietary deal and you're making your own data room and it's Google Drive, get us in there. Let us look through the folders and see what's available. If we're guessing about things like contracts or, guessing about things like asset reports, I'd rather not guess. I'd rather just have the first-hand source data.
And if you really don't want diligence to answer these 6 questions, I think I gave the example of the fire suppression, contractor. You're probably going to assume that contract. It's a large contract. Probably want to have coverage for I think it's 5% of your revenue. There was a claim there.
Well, and I see full value in this. It was
Yeah.
just more so like calculating, okay, so I need financial due diligence, I need insurance due diligence, which now you guys said that they don't actually charge for that's part of basically the process.
Yeah.
That's kind of what I'm thinking is like, well, if I'm going to get a new policy and you guys can look through everything anyways, on the back end, then why would I have you guys up front? I understand why I want you up front, but you're going to catch all that stuff on the back end. But because there's no fee or anything involved, that would make a lot more sense. And I understand.
Our request list also, it's not like we're asking for additional stuff.
We're going to get like loss runs.
You should be, a lot of times the lender will require it. So.
We really try to piggyback off of the other diligence request list so that we know that sellers are trying to get a deal done and run the business. That having that sort of bedside manner of not making your seller go crazy or you pull your hair out. There's a handful of things we push on like loss runs, but other than that, we try to be minimally invasive.
Yeah, this QR code, there's a few documents in there. One is just an acquisition entrepreneur's guide to insurance diligence, and one just kind of lays out, key diligence, questions.
Follow Flat Roof Freddy on Twitter. Thanks, everybody. Any other questions?
Yeah.